New Zealand, compared to Australia, UK, US, doesn't have any tax incentive. Why would the first 10 to 20,000 not just be tax-free instead of having a government contribution? Just forgo the tax, don't outlay any capital. Why would you not give even a small tax break to local fund managers and local KiwiSaver managers? Give them a 5% tax break so that the overall return that they get in New Zealand can be lower and they're going to pay less tax on it. Long term, the capital staying in New Zealand is going to be better for everyone. The number one thing for New Zealand property for the prices to go up, people need to be able to pay more. Right now, the missing key, people can't pay more.
Hello and welcome to another episode of Waste Wealth. Today we are joined by Anthony once again. Anthony, why don't you give us the TLDR just so everyone knows who you are if they haven't seen your previous episode. But prior episode, we did go through your journey and it was really exciting and interesting to see kind of what got you to where you are. But obviously on a day-to-day basis, we like to talk about markets and some of the stuff that's going on. So we thought we'd connect and do another episode.
Thanks for having me. So as I said, Anthony Sage, New Zealand-based financial advisor, primarily in that lending space. So mostly do mortgages, but we are branching into the KiwiSaver and more of the investment side, which is obviously growing quite fast. Half American, half Kiwi. Grew up in the States, lived in Guam, lived in New Zealand, so kind of been around the show. And currently living in Auckland. Just had my first baby about 5 weeks ago, so enjoying that journey. And that's been a big life change for me, sort of balancing the work side of things and the new family.
Totally. I mean, last time we spoke, you were also a brown belt. Now you got your black belt.
Yep. Thanks for that. That was a pretty big achievement for me.
Yeah, that's cool.
Took about 12 years, and I think the average is 10, but anything kind of around that decade is a pretty big commitment, I'd say.
Totally. And you never really know. It's not like linear or like predictable. Like sometimes your earlier belts, you get them a little bit faster and then life happens, injuries happen. Yeah. And sometimes it takes a bit longer, but yeah.
Moving gyms as well. I know I came to Tuka as like a blue belt with a few stripes and Pedro doesn't really recognize that. So you obviously have to not really start over, but like you just basically fresh at that belt and then you have to do your hard yards to get to that next belt.
Totally.
Which is good.
That's cool. Yeah. And I definitely, we rolled last Friday and I felt like your pressure was like, I feel like you've gone like 5 steps higher than when we last rolled.
Thanks,
like,
man. I appreciate that.
Really like.
And likewise to you as well.
Yeah.
I think you must be getting close to that next belt as well.
Yeah, hopefully. Yeah, but it felt like I was rolling with Pedro a little bit. Oh, like it really did. The pressure was strong and it was,
Perhaps I'm not as quick and agile as him. He's very cat-like. I do try to be like that, but I definitely have modeled my game after him. We're quite similar size. And I do roll with him a lot, so I'm definitely getting the rub from him, which is good to see.
Totally, yeah, it's cool. It's good to, it's kind of good to see because I think a lot of people don't. I think it's actually quite good when you have a little bit of a break from rolling with someone as well, and then you're like, oh, whoa, there's been a whole like journey gone on from while I was not rolling.
Yeah, man, I was going pretty hardcore there for a while,
and then you're teaching, right, more.
Yeah, and that's been a big change for me mentally.
Yeah.
Because you do understand it better when you have to explain it to people of all levels.
Yeah.
And it's when you first start doing it, you realize like you might know jiu-jitsu, but you probably don't know how to teach. And it's a different skill where you do have to mentally prepare for that. And I don't know if you've done much teaching, but if you do back-to-back classes, it is quite mentally exhausting because there's all the preparation, you want to do the right thing. And then afterwards, you're critical of yourself like, oh, I should have said this, I forgot that detail. So it's constantly that process. But just like jiu-jitsu, you keep doing it and you get better and better and better.
Sure.
It's fine.
Yeah, it's amazing how teaching can just help open you to new horizons in any domain.
Yeah.
Even just coming on the pod and kind of musing over what's going on in the markets right now, what's going on in the kind of world of wealth, building wealth, keeping wealth. It's quite interesting. So we got a bunch of topics to talk about today. There's obviously a lot of kind of aspects going on in the market, and we're speaking to kind of clients and potential clients, and definitely the ever since the inauguration, really, you've had investors be more and more cautious and concerned and allocating with that way in mind since Trump made office. And but then again, you look at the actual kind of index itself, you would go, well, if you actually didn't tell me the volatility in the middle, I wouldn't really know anything's happened. Yeah. So we're kind of 6 months in now with net not much happening, but actually a lot going on under the hood.
Completely agree. And like you said, you would have expected this large flight of capital out of the United States when Trump got elected because that was a narrative. But you look at the market now and we're still close to or at record highs. And that doesn't seem to be the case.
Well, it's kind of that aspect of how auction-based markets work, right? Like we don't actually know net, right? Where the outflows have been, where the outflows have come from, and kind of what that looks like on a long-term basis.
Completely agree.
Because I'm seeing a lot of smart money talk about basically not being in the US. A lot of the kind of traditional hedge fund guys and the guys that have been around for a while have really kind of talked about there's a lot of opportunity elsewhere. Even if you're a USD denominated investor, which there are lots of those around, even if they're from different places like in the Middle East, Europe, even some investors in this side of the world kind of measure themselves off of the US dollar anyway.
Yep, definitely.
But there's definitely an opportunity going on, especially post tariffs. I was seeing a lot of interesting companies that all of a sudden became almost like no-brainers from my own personal perspective, because the tariffs and some of the nature of like, you know, energy infrastructure and pieces like that had just got very underloved. And then place the tariffs on top of that, you've kind of got the baby's been thrown out with the bathwater kind of situation.
Definitely. Would energy infrastructure be the big one? Or are you seeing that across other industries as well?
A few other traditional industries, atom-based industries, I think you've seen that, but then you've seen quite a strong rollback. Like I was looking at CrowdStrike the other day, had a 34% drop roughly, and then round tripped back up 66% from the low prior to earnings.
Some pretty crazy buying opportunities at the moment when you consider the value that you can get from this volatility. I've seen that in the last couple of months where you just see these massive swings. And in hindsight, it's like, oh, I do wish that I'd put that into perspective long term, because it is hard to, at the moment, when you have a 30-40% drop, like, oh, the market's going to shit itself. Right. You fast forward a month or two and we're now back to record highs. And you look at the amount of people that could have bought in at that value, and it does make so much more sense than the current valuations.
And then it gets harder to make a decision after that. It depends on like what game you're playing, right? Like if you're looking to accumulate quality assets, you look at something like a Google, for example, just such a great business. And you go, wow, they've got all these businesses inside themselves. And, you know, you're probably a consumer of a number of them. And actually, I think they're trading at like 19, I think.
I was going to say the lowest price to earnings ratio they've had in decades. I think the reason for the valuation being so low at the moment, people were quite scared by that antitrust lawsuit coming out of the States. And they thought that they were going to be forced to sell parts of their business, which may or may not happen. But like you said, it's such a diverse business that even if they had to sell a quarter of their holdings in terms of the diverse products that they offer, you'd still have a very good investment opportunity at 19 PE, which, especially compared to its peers, is like half or a third of anything similar that you find in the market. So that's a good point. I've actually been looking at Google, and it is becoming relatively good value, I'd say.
I just look at it and I go, wow, like it's just such a strong business. The founders are now back involved, which I think plays a massive role. And they're stripping out some of that perhaps not so productive internal culture that took hold. And then their moves in AI have been exceptional. And then you put that on top of their kind of business suite, then you go, wow, this is just such a valuable business. Then you throw on Waymo and YouTube and what they're doing in quantum. You've got kind of three tailwinds there. Like obviously YouTube's always going to be strong. And if you were to split the business up and you were to break the assets down individually, you'd probably get a much larger market cap. So there's actually, in the case of an antitrust or at least a spin out, you potentially as a shareholder have an opportunity for the market to price those assets individually at a much higher multiple. So then you get a bit of a spread.
Definitely.
That's the speculation. But I just think like in terms of of the fundamentals of what is this thing, you know, what are the productive like attributes of this asset? You go, wow, they've got a very diverse business. They're actually happy to cannibalize, I think, their ad business over time. because they're going to get very strong subscription revenue. And then you've got the whole kind of cloud infrastructure play plus everything else. So really cool business.
Yeah. Like you said, though, I view Google now almost as like a defensive stock in terms of its portion of your portfolio. If you're a young investor, it's not actually that sexy and exciting because they've already had that massive growth. They're probably not going to sustain it. Like you said, it's still a solid business. It's going to become like Microsoft, where it's just going to keep going up by a few percent each year. Good hedge for inflation, good place to park a bit of defensive cash.
That's right.
But in terms of being the next Palantir or the next Nvidia, probably not. So does it have a place in a portfolio if you're trying to have a long-term, bit of diversity? Yes, but I wouldn't allocate more than a few percent, I'd say, to Google at this point.
Really? You wouldn't even consider it as a bit more of a cornerstone to a portfolio? You would just be like, oh, it's just a part of a diversified set of holdings.
The days of massive gain are behind them. I think they're going to continue the business path that they're on. But those years of double-digit gains in terms of the stocking revenue and all that, probably behind them. As that market becomes more crowded and obviously regulation catches up with them.
Yeah, and it with those American businesses, it's always their ability to reinvent themselves that basically take them to a new echelon of kind of market cap, which you've seen with the likes of of Microsoft and Apple. They've done it a few times, and then you've got Facebook that definitely has played a couple of reinventions of themselves that have propelled them forward.
AMD is another one. I was going to ask you about that. I've always been a big believer in AMD. I made a lot of money on them about 15 years ago when they first boomed the first time. Exited, made a good penny off that. And then I tried to do it again about 5-6 years ago. I think I went in about 150. It went down to about 100. Now it is recovering nicely to about 120, 130. My AI advisors that I cheekily will run my portfolio through Perplexity told me to sell it multiple times. They said it's underperforming. But I did want to ask, excellent. My theory is obviously the success story of Nvidia. It's awesome. A little bit of play in that. I think that's going to become so expensive, both on a valuation and actually product front, that they're actually going to create a case study for bringing up their competitors, where it's like, yes, their chips are 10% better, but we're not paying twice the price. And then suddenly a lot of the demand that would have gone to Nvidia, perhaps they can't fulfill, or people don't want to pay those ultra premium prices. And that's where the likes of an AMD or an Intel come in, take that up. And I think it is a solid business. They've made mistakes in the past, but like you said, if they can reinvent themselves, as they're probably not going to be the preeminent chip maker, but if they can be the number 2, number 3, number 4, they still have a lot of room to play in that space.
Yeah, they have basically not seen the same appreciation that the Broadcoms, the Oracles, and the Nvidias have played. And I think that has been largely driven by, I guess, how they've interacted with the market, and they've interacted with large contracts, specifically Broadcom, Oracle, and then obviously Nvidia. Nvidia is the kind of de facto.
Yeah. We're seeing Samsung enter that space as well, which is quite interesting.
Yeah.
The Koreans are very efficient when they seem to enter markets and kind of set their sights on something. We saw it with
Samsung's an interesting run, right? It's international. It's away from the US. It has a legacy business, but it has very strong kind of background in the manufacturing side that you could potentially take advantage of.
But then I'm not sure if you know about the scandals. The founder almost went to prison a few years ago. The Koreans call it chaebol, which is the large conglomerates that are basically like revolving door with the government. I had a Korean friend joke to me that the Korean word for mafia is chaebol. So that's another level of market risk where Americans perhaps don't understand, or even if you're from New Zealand or from Asia, you probably don't understand the inner workings of the Korean chaebol system. Well, there's that element of risk, like it's a hell of a business, but what's actually going on there, where the founder's constantly being investigated for fraud and the family's going to jail, but they don't actually go to jail, and it's this constant issue.
Yeah, it's these funny little markets. Well, they're not little, but these funny markets where there's basically a very strong and close tie between public and private markets, and you get that same dynamic in China. And that's really what you've got from the US is you've got free market, or perceived free market.
Not quite, but at least people understand the level of it, right?
Yeah.
It's obviously still happening in the US and New Zealand, but as Warren Buffett says, if you understand it, it's a lot better situation in terms of investing.
Yeah.
I'm not going to get rid of it. You're not going to understand Japanese accounting, but you're probably going to have a much easier time understanding accounting in your country.
Yeah, for sure. I mean, like, you kind of not understanding the cultural dynamics of like how assets are going to be priced based on government interventions is like like make or break for certain investments for sure. It's just, I think it's quite a strong theme to be able to play internationals that are strong, that can basically sell into other markets other than the US. And then you've got kind of the long-term theme that basically the competitive nature of chip making will drive competitors to compete with Nvidia. Yeah. And, you know, you're even seeing it like Gemini doesn't run on Nvidia chips. So all the Nvidia chips that Google have bought have been for their cloud business, not for Gemini. They're using TPUs. So it's interesting. They're running a lot of their own bare metal, basically, right? They're running their own hardware. And that's the long-term strategic move to play.
And that is, like, if you went back even 5 or 10 years prior, that would be absolutely eye-watering to even think of that. It's like, no way can a company based in the United States use their own hardware for this sort of thing.
Yeah.
So, I mean, you just understand how quickly the landscape changes, particularly around that chip space.
Yeah.
We could be 10 years forward, and it could be that Taiwan, obviously they're always going to be the preeminent maker, but it could be that they're much less important in just 10 years' time.
Yeah. And the software layer, like trying to extrapolate out what it means for the software layer and how you can get efficiencies from the software layer. Are you able to retrofit some of the infrastructure that, for example, Intel has to actually take parts of the computational load? And then you've got kind of connected to, I think, to the chip trade is like, what does this mean for energy? And like, I think about energy a lot, even though from when you think about kind of trying to stick to what you know and where you have a lot of information, like obviously technology is something that I look at more regularly.
Yeah, same. It's just exciting. It just moves so fast.
But I think energy is an interesting space now, and it's connected to this trade. And I always get a bit dubious where kind of you've got a hot thematic trade like AI and chips, and then the adjacent stories around, we need more energy, like is often makes me a bit like, are we all drinking the Kool-Aid? Like,
we saw that with DeepSeek, where suddenly the Kool-Aid became a bit sour. It's like, wait, we're valuing the American AI companies at how much?
Yeah.
And we have this Chinese company, whether it's true or not, what they spent, probably not true. But even if it's not, even if it's a fraction of what they spent, it still just disrupts that story that's being told on Wall Street, where we need to pay hundreds of billions of dollars for valuations for these companies that are doing things that others can't.
Yeah.
So very interesting.
Yeah. So I like the idea of kind of saying, hey, what's less in favor? I think that's the AMD story. It's like, hey, it's less in favor than Nvidia. It has a very similar track record in terms of brand positioning and kind of that kind of background in gaming to more broad-based use for their chips. But it just hasn't got loved by Wall Street. I mean, if you look at like Micron, we were talking about Micron in the office the other day. One of the guys at our office said to me, what do you think of Micron? And it was trading at like $77. And I was like, yeah, it actually looked really interesting. And I said, what? And I went and looked at the options pricing, and I said, man, this thing is the market's pricing this like it should be back at 100 in no time. And I think the last time I checked the price, it was 122. So those options would have like 22 times their value. And the market was pricing a pretty significant move, not to this degree. But that kind of plays into, I think, the basically, if you think about portfolio construction and like capital gains, and it kind of segues off into private credit and private equity that's kind of very popular at the moment and becoming
a bit of a bubble
potentially, but also becoming like commonplace to talk about and actually even give access to retail investors in. So we can go kind of segue there. But essentially, if you use the same comparison between gold and Bitcoin, Bitcoin is 5 times more volatile than gold. And in a sense, like what you're paying for, like your capital gains is tied to the amount of vol you're willing to actually withstand.
Yeah.
And that's kind of
stomach, if you will.
Yeah, it's very clear with like the gold versus Bitcoin trade, which it wasn't clear if obviously, and it still isn't clear if that correlation will sustain. because it really, both of them are actually kind of volatile, but also trending up due to geopolitical issues and because of a distrust for the US right now. So that's like the same trade. And prior, you would have gone, well, is it really a similar trade to gold, or is it just a high momentum, kind of high beta trade that actually just follows like tech companies in the US? And I think that kind of discussion is currently a little bit blurry right now because you don't really know. But in a portfolio, you're basically paying, or your gains are kind of related in a sense to the vol you're willing to withstand.
Definitely.
Providing you're not buying something that can obviously blow up or go to zero.
Yeah.
And then with private equity and private credit, it's similar, but without the vol. And what you're seeing now is where people go, oh, well, the IRR looks really great. Well, that's because the vol and the Sharpe ratios, the different ways someone would measure if a portfolio performance is any good. A lot of, you would use maybe a Sharpe ratio, which actually it punishes volatility.
Yeah. But is the volatility hidden? So case what is one? It's in Lehman Brothers 2008. They had a valuation on paper, but the actual valuation of the business is heavily dependent on the quality of their loan book. And as we found out in 2008, the quality of the loan book was shit.
Yeah.
So are we seeing that now with private credit, where, like you said, on the face of it, there's actually not much volatility, which is good. You want to invest in that. But behind the scenes, what they're actually using the capital for and funding these loan books, is it the quality that they say it is? Probably not. And in my opinion, as the loan book changes, obviously loans are constantly repaid, being put out at different risk levels, the volatility is fluctuating. Yet the private equity that's being listed as an ETF or to retail investors isn't accurately representing that. Yeah. And that's where the danger is, in my opinion.
Yeah, it's kind of where you get to that point in the cycle where basically you're potentially seeing an offloading of what we call the bag, right? From institutions to retail, so finding liquidity for that market, and I think that's really where things come under issues is when liquidity gets affected.
Yep.
And there's a Apollo, for example, and these other companies. They really want to make private equity as liquid as possible, so they want to create ETFs. They want to get more people into funds.
We've seen this before, though, right? We saw this with CDOs being offloaded onto retail investors. Right, to get all these shitty mortgages off our book. We're going to make them look sexy and package them up as something they're not, and sell them to retail investors that don't really understand what they're buying.
Well, and this is really quite technical, so I think it's hard to explain well, but I'll give it a go. Is that in the current dynamic of the markets where there is more access, you have these private equity firms, they're actually able to, and let's use MicroStrategy as an example.
Yep. I'm a big fan.
Of the company?
Of the company and of the CEO, yeah. I actually don't hold Bitcoin, but I hold MicroStrategy. I let them hold it for me, obviously, because they're leveraging it and they're borrowing money to buy more. I like that element of it.
Okay, cool. Well, and you would go, on face value, you would go, why would any institution, private equity institution or investment bank or hedge fund ever give these guys convertible loan with like 0% interest, and like it just doesn't make sense.
Yeah.
Like, why are these companies willing to go and give converts to this company to trade a volatile asset like Bitcoin?
Infinite money loop, they call it.
Yeah. Well, I can tell you why they're doing it. So what I can do as a hedge fund or a private equity fund that basically writes that convertible note. So I go to you, your MicroStrategies, and I go, hey, I'm going to lend you some money to buy Bitcoin.
Yep.
And I'm actually not even going to charge you a rate, or I'm going to charge you a very favorable rate. And I'm going to be able to get a claw back on the assets if you blow up. Like, that's like the kind of general arch of and you go, well, why are they doing that? Do they really want the Bitcoin?
No, I think they're selling covered calls on the upside.
That's right.
That's what I think's going on.
So because the options market now in America, but globally, is so popular, they actually don't care about the loan that they write, because they're essentially going to the market and writing calls
on both sides.
On both sides, but twice or three times the volatility.
Yeah.
So you're basically getting this huge premium for people to speculate on the price of MicroStrategies, and that premium is funding the loan. So then if the loan goes bad and the business blows up, they don't care. They end up with a bunch of Bitcoin, and they probably made 2 or 3 times their money over a couple of years just by playing the derivatives market. So basically going to people that are speculating in the market and go, hey, you think MicroStrategy is going to go to 300? I'm going to pay you, you're going to pay me $50 in premium to do that for 6 months. And they're kind of making this kind of, yeah.
And someone like Trump is just lending himself this whole situation because volatility has never been higher. So that is a good, I think last time I brought up, there's a similar fund as well. It's called the JP Morgan Equity Premium Fund, JEPI.
Yeah.
There's also JEPQ. Yeah. And they're doing exactly that. So they hold 80% basically S&P 500 assets. The other 20%, they're just buying covered calls, and they're making premium income of 5 to 10% paid monthly, which is absolutely insane that this, like you said, it's so popular now. It's a strategy that just works, where they're just basically profiting off the volatility created by the climate.
Yeah. And I wonder what unravels that trade, because I've actually personally held JEPI.
Yeah, I've got some quite along it. The argument would be no capital appreciation, but when you're paying a 10% dividend month on month for 5 years plus, you don't need capital appreciation.
Yeah, and you can use other parts of your, you can use other parts of your book if you want capital appreciation. But I think it's a nice, for me, I've used it as a nice additive to a kind of income strategy that I've been running. And it's just like, yeah, I'm happy to get cash flow in this volatile time. Yep. Also, because they're selling the covered calls, you actually get less downside in the case of it. Of the market kind of going down. The problem I think you have is you have some tail risks associated with that product that I don't think you can predict too well.
Yeah, well, we haven't seen it yet.
Which we haven't seen, and you basically just don't know the kind of the knock-on effects of some kind of outlier event that could basically turn that strategy into a bit of a mess. Because of they probably aren't selling covered calls on the entire basket of the S&P, and I believe they're picking and choosing. Which creates, kind of far right tails, which can be a little bit of a problem. So I guess if we moved on to the kind of KiwiSaver landscape, we've had some changes this year.
Yep.
And we also have some general trends again in the KiwiSaver space around a mix between, public equities and more KiwiSaver funds getting into private assets.
Yeah, a little bit of that.
So that's coming. And then you've got the added contribution piece. And then we've also done some interesting data on the cost of KiwiSaver on an aggregate basis since the start.
Yep.
So it's an interesting space. There's lots of exposure to the US in KiwiSaver apparently.
Yeah.
And then you've got a more and more optionality into private markets, private assets, and typically not directly invested by the KiwiSaver fund.
Yeah, I've seen a few get in trouble in that regard because they have to be very careful how they go about finding, procuring, and valuing these private assets. So obviously there's a lot of fudgery that can go on in that.
Because how do you mark a bunch of private assets? Very difficult.
Exactly. Particularly if it's a company or an asset that your fund also owns in other segments outside of KiwiSaver.
Yeah.
We've actually seen, I won't name any names, but there are a few fund managers that actually got in trouble for that, where they were in bed with certain assets, and then suddenly the KiwiSaver scheme was also buying privately listed assets at X valuation.
Yeah.
And it's just the whole thing's a little bit too close for comfort in terms of regulation.
Yeah, it becomes difficult. I think from a productivity perspective, it sounds very good to get into private assets. And I think that it can help the country. And I think that, we need to be optimizing for improving the amount of productivity units we can get out of businesses to basically increase multiples so that natively based assets can thrive.
Yeah.
And at the moment, there's 2 issues in that space, which is that companies get bought out too quickly and that their multiples are relatively low compared to comparative companies around the world.
And there's also no incentive. I think we talked about this last time. I think the KiwiSaver changes were far too weak. It's you went to 4 and 4 from 3 and 3. Australia's 12, so we've still got a gap of 4%. If you're going to make any changes that are probably quite expensive to do the legislation, why wouldn't you go further than that? New Zealand, compared to Australia, UK, US, doesn't have any tax incentive, both on the personal side.
Right.
Why would the first 10 to 20,000 not just be tax-free instead of having a government contribution? Just forgo the tax, don't outlay any capital. Then number two, obviously a lot of the funds, like you said, are overweighted in the United States because they're chasing that return.
Yeah.
Why would you not give even a small tax break to local fund managers and local KiwiSaver managers? Give them a 5% tax break so the overall return that they get in New Zealand can be lower and they're going to pay less tax on it. Long term, the capital staying in New Zealand is going to be better for everyone.
Absolutely. I think there's a bit of an interesting dynamic there where you actually don't want to dissuade like productive capital being allocated to the best assets.
I agree.
Right?
I agree.
Which is kind of a counter argument to like a fifth.
Yeah.
But at the same time, we want more productivity in the country. So you got to balance that.
Yeah.
I think.
Yeah. And I don't think even if you had a massive tax break, even if it was 50%, I don't think suddenly the fund managers would just take everything out of international markets and come into New Zealand. It'd be too risky.
They need to be liquid too, right?
Exactly.
So they need liquidity given the withdrawal rules and everything. What I've seen on an aggregate basis is for every dollar that a Kiwi has made in KiwiSaver, they've spent 25 cents on that dollar in taxes and fees.
Which is kind of disgusting.
Yeah.
Yeah. So people complain about a 2% management fee on a investment. And here we have basically the government charging a 25% management fee.
Yeah.
Kind of disgusting.
Well, so it's not, so
not ongoing.
Yeah. So 60% is management fees of that cost. And then 30% is tax, roughly.
Still no incentive though.
No, like you should, like that 30% tax is obscene.
Yeah.
Because like you, even if you just took away, you cut that in half, you're giving this saver more, right? And it's also trapped capital at the end of the day. Like I heard that in the early days, they were thinking of actually allowing KiwiSaver to potentially open up for like business activities.
Yeah, we talked about that.
Yeah, which is real interesting.
But there would have obviously been a lot of fudgery in terms of like what business are you creating.
It does create a lot of issues. But what it also does is it unlocks trapped capital, which I'm always in favor of.
Definitely.
And it creates an incentive for for the overarching kind of scheme, the KiwiSaver scheme, to have to be more competitive.
Yeah.
Because if I'm having to fight for that capital, whereas right now it's like, hey, you've basically got this huge amount of wealth being built, not necessarily as much as it could be for savers, but in the fund management business and the banking industry, right? Because it basically goes from the fund management industry, which a lot of the default schemes are obviously with the banks anyway, and
Cultures are changing,
which is thankfully changing.
Thank God.
And then basically that money gets transferred into a loan.
Yep.
So, and it's not that that's bad, that's great. Like we need those railways for people to be able to save and be able to buy assets.
Absolutely.
But what you want is a competitive tension so that you've got reasons for capital to be nimble,
yep,
but then for the incumbents to then be like, well, I'm going to have to cut my management fee.
Yeah.
Or from a government perspective, we're going to have to actually make it more interesting for people to save in KiwiSaver. Because if you're a sole trader or you're a business owner,
advantage.
Is there an advantage to having a KiwiSaver?
Well, they did have obviously if you contributed, it was about $20 a week in the previous regime, which has just ended.
Yeah.
The government would match the first 50% up to about $1,042.
Yeah.
That's pretty tiny in the scheme of things. And they've actually taken that away. My sentiment is if you're going to make the changes, why would you not just take that away completely and then make the first 10,000 a tax-free or at least a tax-attractive investment in terms of a lower tax rate to put that first 10K in there to incentivize it?
Totally. And I also think that there's a little bit of a misunderstanding with the, I've heard a lot of people that kind of talk about, the government are taking away that contribution, right? And then with the guise of, with all this inflation, they shouldn't be taking away that incentive. It's like, well, by the way, that is actually what potentially creates inflation are those sort of activities.
Yeah, definitely.
And I guess fifth tax must, and I haven't looked at it, I should.
They need to get rid of that. That's downright embarrassing, to be honest.
True, but I mean, how much revenue they must be generating a lot of revenue from it right now. Because another interesting thing is funds are more inefficient from a fifth perspective than owning the underlying assets themselves.
Tax drag.
Yeah, there's a tax drag on it because you're basically paying it the whole time before you get to that first threshold, and on the fund itself. So actually more inefficient to own US or foreign assets in funds. So technically, if you own them directly, there's some tax benefits there.
And not only that, but just like GST, they've created an entire industry on both sides, people working at the IRD and people working against the IRD. How much time are they spending on compliance? As I understand it, the FIF rules are insanely complicated, and it's not beneficial for anyone having to spend hundreds of hours a year allocating time and resource to making this compliant when you could simplify the whole process.
Yeah. And just adjust it slightly, right? Like you don't have to go full.
The current rules are a cost basis of 50K. So technically, if you'd only invested 49K 100 years ago and you had $1 million, I think you'd still be under threshold. But 50K being the threshold in the current climate, come on.
Yeah, it's not.
Show me the figures of what that was even 10 years ago. That's probably 30K 10 years ago. So it's not much money. The average KiwiSaver balance is 30K, in fact.
Yeah, it is.
I think KiwiSaver is exempt. The funds obviously do the FIF on behalf, but they just need to be a little bit more streamlined in that regard.
Yeah, for sure. So kind of going broader away from markets, what are you seeing in the kind of general kind of consumption of like the housing market and kind of how people are feeling on the ground?
Still a really weird time. I get asked this question a lot. The interest rates have come down quite fast.
Yeah.
So go back about 2 years and we were kind of in the high 6s, 7% region. Now we're suddenly in the high 4s and dropping. I think we've seen the biggest cuts behind us. Normally, Kiwis would say we've had about a 2% drop on retail mortgage rates. Sugar hits coming. Where's the capital gain? But at the moment, we're not really seeing that yet. I think the economy is still really bad. And the missing ingredient is immigration. So as we've seen in the past, when you have those low interest rates and you have high immigration, the market goes nuts. But right now, we're missing one of those key drivers. So we're seeing people a lot more relief in the mortgage market. Their payments are coming down.
Yeah.
A lot of people that were wanting to sell or having to sell no longer have to because they can start to meet those repayments on lower rates as long as they have the right structure. But we're not yet seeing the market be able to pay those higher prices. And that's the main driver. I heard a quote, basically, the number one thing for New Zealand property for the prices to go up, people need to be able to pay more. Right now, the missing key, people can't pay more. Even if they wanted to, $1 million house, they can probably pay 80-90% of that, $800,000-900,000. They can't constantly pay a higher and higher amount, even though the test rates and the interest rates in terms of cost of capital are going down. The incomes and the overall living costs in New Zealand have gone up so much, they filled that gap.
Yeah. And I guess you do kind of have a potential opportunity to see almost artificial demand if there was more reason and more immigration. Right, more reason to not be in different countries like the US or maybe even Asia. You could then, what I wouldn't want to see is I wouldn't want to see a full loop. I want to see sustainable growth. And obviously you can't predict how humans act in markets because you don't want another, what I would call almost like an artificial re-rate of assets, because that basically just affects the consumer here, right?
No, I completely agree.
Because it actually just affects the average consumer or middle class person trying to actually build equity.
Yeah, and most people that own houses now are saying, oh, the RBNZ's got it wrong, the banks have got it wrong, they need to cut rates more. I'm actually sitting here like, pump the brakes. We've seen that during COVID. We saw what happened when the rates go artificially low too fast. I would rather have a long period of decent economic prosperity than have these massive up and down sugar hits, which we saw during COVID. We're fast forwarded now almost 5 years on COVID, and basically all the gains that were created during those phantom 30% years have been erased.
Yeah.
Do we want that? Or would we rather have the historic average for interest rates is 4%? We're now in the 4s. How about we stay around 4 for the next 5-6 years and have that long-term boom rather than having these massive boom and bust cycles?
Well, and like you got to kind of measure yourself in maybe the reserve currency, right? Because like if you might say, oh, well, my house price is actually the same or it's slightly higher. But you go, well, actually, is it? Because if you measure it against the US dollar, it's actually gone down like significantly.
Especially inflation adjusted on infinity cost.
Yes. Our inflation and kind of relative cost is, to own a home, if that gets, so basically what could happen if rates continue to drop and, for example, perhaps the US bond market reacted to what they're doing with their deficits, it can create a double whammy effect where basically you have rates in the US actually start to trend up again while rates in New Zealand are coming down again, which means that you have that tension where your asset price on a USD based or even a Bitcoin related price has got whacked.
Which we're starting to see loans in Bitcoin. I was going to ask you about that. That's interesting as well. We won't probably not time again that today, but that is becoming a thing as well, where people, particularly there are banks in the United States, basically letting you trade on margin or take out a loan against your Bitcoin, which is extremely interesting.
Yeah, totally. Yeah, awesome. Well, I think we've probably run out of time for today, but maybe next time we can have a bit of a conversation around the modern portfolio construction and how people are actually representing their capital and representing their assets going forward. Because I think the whole kind of how people are representing their capital is changing.
Absolutely.
And that means that how people actually deal with how do I actually leverage my asset base is going to change. And that's going to be something that we're going to be looking out for. And we've got a lot about how do we innovate with, on that inequity. Like, shouldn't someone with $1 million equity portfolio be able to leverage similarly to someone that owns a home? I don't know the answer to that, but it's definitely something we ask ourselves in terms.
Absolutely. Definitely keen to have that conversation.
Awesome, man. Well, thanks for coming on, and that's right. I'll meet you again soon. Cheers, man.